Good afternoon, ladies and gentlemen. Today's JSE topic, using fundamental analysis to build your portfolio, as I'm sure it will be valuable to all of you that are busy with the JSE challenge. So let's just get into the presentation. So what is fundamental analysis? Well, it involves looking at quantitative and qualitative information to gain insight on a company's future prospects. When we talk about quantitative information, we're talking about financial aspects, looking at your income statement, your balance sheet, and your cash flow statement. And qualitative is more the macro and economic aspects and the environment that the company operates in. The primary assumptions of fundamental analysis. The main one is that the market is inefficient and the share price of a company does not fully reflect its intrinsic value. Now, the intrinsic value is what the company is worth. So in the long run, the assumption is that the long run efficiencies will be corrected and a company's share price will reflect its underlying fundamentals. So it would move towards its intrinsic value. Therefore, fundamental analysis attempts to determine a company's intrinsic value based on the underlying factors that affect the company's actual business and its future prospects, to determine if it's trading at a discount where you're getting an opportunity to buy, or at a premium where it gives you a signal that you should sell the stock. So when we look at fundamental analysis, we can look at it from the top-down approach or the bottom-up approach. So the top-down approach, we look at the macroeconomic analysis first. What is happening in the local economy? The GDP, inflation, the exchange rate, what's happening with interest rates. And then from there we go down to industry analysis, where we'll discuss Porter's 5 forces later. When we've done industry analysis, we will go down to company analysis, where we're looking at specifics of a company, the management of the company, profitability, and growth expectations. So the top-down approach is very qualitative, and it looks at a macroeconomic picture going down into the sector or industry growth. Whereas a bottom-up approach is more quantitative, where we're looking at company analysis. We're trying to identify companies that have got good prospects based on reasonable valuations, or they could have a history of earnings growth, or they could have future growth expectations that are quite good. And from there on, we'll look at the industry to see what is happening in the industry that makes them contrarian, and then at macroeconomic analysis. So the qualitative factors, the industry factors that we will look at when we look at a company based on fundamentals. We look at the customers. What is your customer base, and is it a long-standing relationship that you have with these customers? And are they, is it difficult to gain them, and how easy is it to lose them? And your market share. And with market share, we talk about your economic moat. Your economic moat is the reason for your business. It is why the business will be sustainable and what differentiates you from any other business or any other business model. And then we also look at economies of scale. If you are a manufacturing company, is there economies of scale that gives you bigger market share than your competitor? We also look at industry growth. If you look at the telecom, the mobile telco market that is currently highly saturated, what is the potential for growth going forward for the industry in which this company operates that you're looking at? And competition is also important. What is your barriers to entry? We will look at Porter's 5 forces with regards to that as well. And then regulation. Would there be any changes in legislation or regulation that could potentially impact on an industry and make it less secure, or make it or turn it around that it could actually benefit that industry? If you're looking at carbon taxes, manufacturing companies that produce high carbon taxes, they could be impacted severely if that regulations should go through and be implemented, and that could affect the earnings of industry and companies. So Porter's 5 forces. Whenever we talk about competition, we talk about Porter's 5 forces, and it tells you about where the positioning and the operating effectiveness of a company is within its industry. So if we start at the top left-hand side, the bargaining power of customers and the determinants of buying power. What is the buyer concentration? Your buyer volume. Is it difficult for a buyer of your product, for your customer, to switch products, that they're not dependent on your product? And how easy is it for them to replace your product with substitutes? Then threat of new entrants. What is your barrier to entry? Is it economies of scale? Have you got a niche proprietary product that no one can duplicate? Do you have brand identity? What is the switching costs involved as well from moving from your product to a new entrant, if they might give discounts? And then cost advantages. Do you have any cost advantages that could remain there, that could create a barrier to entry? Threat of substitute products. Substitution threats come in if your is your product easily replicatable, or can they take something out that can still do the same, add the same value or do the same thing that could make your product redundant? All these, so bargaining power of suppliers, or that is the last one. So also differentiation of inputs. Switching costs of suppliers. Is it difficult for you to switch to a different supplier that might give a better or a cheaper product? Again, the presence of substitutes. Do you have any opportunities available where you can substitute products to make it more cost effective or to increase the quality of your product? Supplier concentration. Are you a price maker or a price taker? And the importance of volume. If it's a manufacturing business, and your inputs, you have a lot of inputs, is it important that you are volume-based, that you can get price rebates? Impact of differentiation. What makes your product different? Again, the suppliers product different. And the threat of forward integration. What is keeping that supplier from actually producing the same goods with the inputs that you are buying from him? So all these factors are important to know where a company is placed within an industry to see what their competitive advantage is and if it's a sustainable competitive advantage. So out of the Porter's 5 forces, we can then also look at specific quantitative factors of a specific company. We're looking at profitability, which we will find in the income statement. When we look at revenue, is the company growing at more than the current inflation rate? So is it actually expanding its business? And then net profit is key. Gross profit and operating margins are important because that is how you run your business. But profit is the key to understanding a business and if it's making money. So when we move to the balance sheet, looking at solvency, does the company have the ability to pay its debts, all its long-term financial obligations? Does it have long-term financial obligations? And in terms of growth, how is it going to fund that? Liquidity is also important, because how do they pay their day-to-day operations and fund the growth? Is the company cash generative? And then it comes down to the free cash flow. What cash can the company generate after they've laid out all the funds to maintain or expand its asset base? So once we looked at the qualitative and the quantitative aspects in terms of the industry and the company, we can build a SWOT analysis. SWOT analysis looks at the strengths, the weaknesses, the opportunities, and the threats of a company. Now, the strengths is always helpful. A strength and opportunity is helpful to achieve the objective, whether it is growth or it is expansion. And your strength is an internal origin. It's attributes of the company. Does it have a niche product? Is it a long-standing business? The weaknesses are what is harmful in achieving your objective. Does it have high debt? Is it in a market that is very competitive? And then we're looking at opportunities, which is external, which is part of the environment. If the infrastructure boom is coming, what opportunities does that present to the company to grow? Can they move cross-border? Any influence that the environment might have to help them achieve growth. And then threats as well. What threats do you have? And we're looking at, again, at regulation, at sustainability of a company, sustainability of an industry. So once we've looked at a SWOT analysis, we're going to look at how we're going to value these companies. And fundamental approaches to valuation, we normally get two. We get intrinsic or absolute valuation, or we get relative valuation. So absolute valuation relates again to the value of an asset based on its intrinsic characteristics. And that is what we've been going through the past couple of slides. What is the characteristics of a company and what is its capacity to generate cash flows, and then also the risks of the cash flows. Examples of intrinsic valuation models are the dividend discount model and the discounted cash flow valuation. On a relative valuation basis, we're looking at estimates of value of a company when we look at price of comparable assets that are the same as the company that we're looking at, and then we use a common variable. So some of the most common and useful methods in relative valuation are the price earnings ratio, the PE ratio, your ROE, which is your return on equity, your operating margins. Because we're looking at the same industry, you're looking at their operating margin should be comparable unless the companies have different business models. We also look at enterprise value and your price to book value. So when we look at absolute valuation models, we start off with the dividend discount model valuation. So what is the dividend discount model? It defines cash flows as the dividends to be received. So when is it appropriate to use the dividend discount model? Well, a company should have a history of dividend payments, and the dividend policy should be clear and it should be related to earnings. So we should say that a dividend cover of 3 times, or you're paying out a certain percentage of your earnings every year. If there is no dividend, if it's not related to earnings, we cannot use a dividend discount model. And the dividend discount model comes the perspective of the minority shareholder. So the advantages of the dividend discount model, that it's theoretically justified. The investment today is worth the present value of the future expected cash flows he expects to receive. Even if he decides to sell the company, it's still the dividends that should have come to him if he was a holder. So dividends are also less volatile than earnings and free cash flow, and would reflect the long-term earnings potential of the company. You would find that companies that are in highly saturated markets, or they are older, mature companies, have a larger dividend payout, which is much more stable. Also get a better understanding about the underlying characteristics of a company. The disadvantages of a dividend discount model is that it's very difficult to implement for companies that are not currently paying dividends. So if you look at small cap or startup companies that are reinvesting all their money in growth, you cannot use a dividend discount model. And also the minority perspective implies that the minority shareholder cannot control the dividend policy because of their minority stake. We won't spend too much time on building dividend discount models, but just two important formulas for computing your dividend discount model. The capital asset pricing model, also better known as the CAPM model, is where you estimate your required rate of return. So it is your risk-free rate that is normally a long-term rate. So it would be your bond rate that's got the longest time maturity, which is around about normally 10 years. Your beta measures how your returns on the company are related to changes in the overall market. So that's your systematic risk. So if the general market goes up by 1, does the share price react go up by more than 1% or less than 1%? And then your expected return on your market portfolio and your expected market risk premium is your expected return on your market portfolio minus your risk-free rate. So that gives us the capital asset pricing model. From there, we can slot in our required return for our Gordon growth model. So we say the value of a company is equal to its dividends that it just paid times 1 plus the growth rate. So that is the growth rate of the company that we're expecting, divided by the required rate of return minus the growth rate. So when we move along to the discounted cash flow valuation, what is the discounted cash flow valuation? It is the present value of expected cash flows on the asset. And we need quite a lot more information on a DCF than we need on a dividend discount model or a relative valuation model. We need to estimate the life of the asset. Are we going to say that the life of the asset is 10 years, is 20 years? If it's a going concern, we need to build our model that it is consistent if we're going to compare different companies. We need to estimate the cash flows during the life of the asset. And the cash flows, that is where the tricky part comes in, because there are different ways of estimating cash flows of this asset. And then we need to estimate the discount rate that we're going to apply to these cash flows. The advantages of a dividend of a DCF is that the valuation is based upon a company's fundamentals. Therefore, it's less exposed to market moves. And if you look at the Warren Buffett way, they say good investors buy businesses, not shares. So what are you getting from the asset? What is that company all about? What is the characteristics of that company that is going to provide the growth? The disadvantages of using a DCF valuation is that it requires explicit inputs. So you need to know, again, the life of the asset, the cash flows that they're going to generate. So there's a lot of forecasting in that. And you need to know the discount rate. It is subjective as well, because all these inputs, the information that you are going to punch in, could be very noisy, and you can easily manipulate it to get the answer that you want. The other disadvantage also is that there's no guarantee that the company will emerge as an overvalued or an undervalued company. You will purely work out what the company's value is. So calculating a DCF, like I said, could become a little bit complicated. There are different ways of calculating your free cash flow to equity. You can get it from your calculation of the free cash flow to firm. You can get it from your net income, or you can get it from your cash flow from operations, which is from your cash flow statement. So the value of equity is your free cash flow to equity in the following year divided by your required return minus your growth rate. We will not go into too much detail in terms of absolute valuation models because we need a lot of time to go through the methodology and the formulas to calculate these models. I would rather like to spend some time on relative valuation models. What is relative valuation? Well, it is where you take a company and you estimate the value of this company based on the market prices of comparable assets, of companies that are the same as your company, that's got the same attributes. And that is what, and you get that, the market prices of similar companies is what the market is willing to pay for it at the moment. So the information that you need to do a relative valuation is a lot less than what you need to do absolute valuations. You're looking for an identical asset, comparable or similar assets. So if we're looking at, for argument's sake, the telecoms industry, we're looking at MTN and Vodacom, or we're looking at construction. We can compare Group 5 and Marion Roberts and Wilson Valley Homes and Avenge with each other. And then we're looking for a standardized measure of value. Are we looking for price? Are we looking for enterprise values that we can measure them up against each other? The advantages of relative valuation models are that they're more likely to reflect market perceptions. There will always be companies that are overvalued or undervalued. Because we are busy comparing it to each other, there will always be something that looks like it's cheaper or more expensive compared to each other. Remember this, we're comparing the companies to each other. And it requires less explicit information. The disadvantages of using relative valuation methods is that a company that looks undervalued on a relative basis, therefore compared to companies in the same industry, might still be overvalued in terms of their price. The relative valuation method assumes that the market is correct in aggregate, but it makes mistakes on individual securities, and that is where you can almost say the arbitrage comes in, that where you can take advantage of those mistakes. And implicit assumptions made about the variables could have a negative effect on your valuation. So when is it easiest to use the relative valuation methods? When you've got a large number of comparable companies available, all the companies are listed entities because we need pricing on those companies. And there exists a common variable to standardize the price. What type of investor should use this method? Investors who have relatively short time horizons. Investors that are judged based on a relative benchmark. If you're a portfolio manager and you are based, your portfolio comprises top 40 stocks and you are judged against a benchmark, the ALC or the JSE Top 40 Index. And then investors that can take advantage of the relative mispricing. So it could be that you are not in the market, that you are another company, and you in the same space, and you can see that this company is undervalued, and you can buy it cheaper and consolidate that into your business. So if we start with the price earnings ratio. Your PE ratio is your market price per share divided by your earnings per share. Now, in the market, we have different terms for PEs. You get your current PE, which is your current share price divided by your most recent earnings per share. Your trailing PE, which is your current share price divided by your earnings per share in the most recent 12 months. And then your forward PE is quite critical to look at in terms of growth. What is the company's forward PE? What will the company's forward PE be? So that is your current share price divided by your expected earnings per share for the next financial year. So a perfectly undervalued company will have the characteristics that it's got a very low PE, it's got high expected earnings growth, low risk, and high return on equity. And when we find a company with a low PE, we need to ask a number of questions. What are we expecting in terms of earnings growth? Is there a lot of risk in the company? And how efficiently can the company generate its growth? Is it dependent on certain industry factors, certain company factors that all need to play a role? And because efficiency is very important in establishing sustainability of earnings. So when we've looked at PE, and now we're looking at the PEG ratio, the PE to growth ratio, where we're just adding the growth, expected growth to build another ratio. So your PEG ratio is your price earnings ratio divided by your expected growth rate in earnings. If your PEG ratio is 1, we're expecting that your PE and your expected earnings growth should be the same, so a company is seen as being fairly valued. If your PEG ratio is less than 1, it means that your PE is either lower than your expected growth rate, or your growth rate is higher than your PE, and that is a company that's seen as undervalued. If your PEG ratio is more than 1, the market is overestimating their company's expected growth, and therefore we can say that the company is overvalued. So in general, companies with PE ratios less than their expected growth rates are viewed as undervalued. The possible pitfalls when you're looking at your PEG ratio could be that high-risk companies will trade at a lower PEG ratio than lower-risk companies. So they look undervalued, but they are really not undervalued. And then you can also look at companies that grow more effectively and efficiently will have higher PEG ratios because the market is giving them a premium price earnings. And they might look overvalued, but they are really not overvalued. So moving on to the price to book ratio. Your price to book ratio is your market value of your equity divided by your book value of your equity. And we want to use this ratio because it's got a number of advantages. It is usually, your price to book value is normally positive, where your earnings ratio that you use in your PE ratio and your PEG ratio could be negative. And therefore, we would rather use a price to book ratio when we can't use a PE ratio. Your book value is also more stable, and therefore it is better to use your book value that, where your earnings per share is volatile. So when a company is having internal issues or industry issues and your EPS, your earnings per share over years are not stable and growing, we would rather use a price to book value. And the appropriate measure of net asset value for companies that hold liquid assets. So when you want to value on a relative basis, you want to value financial companies or insurance companies that hold liquid assets, you would rather use a price to book value than a PE value. And it's also useful for companies that are expected to go out of business. So that gives you the true value of a company. So companies trading, not trading as a going concern, or companies that are expected to close down. The disadvantages of using a price to book value is that it does not reflect the true value of intangible economic assets. So your human resources, the management that build the business, that adds the value, you cannot quantify that. And it could be misleading when there are significant differences in the asset size of comparable companies. So if you look at an industry and you compare a top 40 company in that industry to a small cap company, and then these companies all could have different accounting conventions that could reduce the comparability in the way they account for their assets or they structure their liabilities, or it's on or off balance sheet. That could make comparability very difficult and could give you the wrong answer. So how do we interpret the price to book ratio? So a low price to book ratio signals that a company is undervalued, whereas a high price to book ratio signals that a company is overvalued. When we look at another relative valuation method, the enterprise value to EBITDA ratio. Your enterprise value is the market value of your common stock plus the market value of your preferred shares plus your market value of debt plus your minority interest, and then you deduct your cash and investments from that. So your EBITDA is your earnings before interest, tax, depreciation, and amortization. So if you want to work out your EV/EBITDA ratio, you have to divide your enterprise value divided by your EBITDA. And this ratio indicates the value of the entire company, not just the equity. The advantages of the EV/EBITDA ratio is that it's more useful than your price-earnings ratio when you're comparing companies with different degrees of leverage. Earnings before interest, tax, depreciation, and amortization. So if you want to work out your EV/EBITDA ratio, you have to divide your enterprise value divided by your EBITDA. And this ratio indicates the value of the entire company, not just the equity. The advantages of the EV/EBITDA ratio is that it's more useful than your price-earnings ratio when you're comparing companies with different degrees of leverage. It's also useful for valuing capital-intensive companies that have high levels of depreciation and amortization. So if you look at capital-intensive companies, that could be like an Equestra that's got a mining division that is highly capital-intensive. Some of the construction companies are highly capital-intensive. And again, your enterprise value EV/EBITDA ratio is usually positive when your earnings per share is not positive. So again, it's useful when you cannot use your PE or your PEG ratio. The disadvantages is if working capital is growing, your EBITDA will be overstated in your cash flow from operations. And again, it ignores different revenue recognition policies. So if you account for your revenue differently, it makes comparability very difficult. The interpretation of the EV/EBITDA ratio is that a low ratio could indicate that a company is undervalued, and therefore a high ratio could indicate that a company is overvalued. So now that we've looked at relative valuation, let's look at an example. So we're taking the big four construction companies, Wilson Bailey Homes, Murray & Roberts, Avenge, and Group 5. And we are going to apply our different relative valuation metrics on these companies to see which of those are undervalued or overvalued compared to the industry. So if we calculated we got the share price, we got the current PE, the forward earnings per share, the forecast earnings per share, you can get easily from data providers like Bloomberg or iNetBridge that normally pull consensus forecasts from different institutions, from the different brokerage houses. And then we can work out the expected growth rate, your forward PE, your PEG ratio, and your EV/EBITDA, as well as your price to book ratio. So looking at the results, we look at a forward PE. based on the growth that we're forecasting, we're seeing that Wilson Bailey Homes forward PE will go from 11.84 to 10.1, whereas Murray and Roberts is expecting more growth, earnings growth, so they go from 11.02 to 9.46. Avenge's expected growth rate is over 100%, so they go from a current PE of 20 to a forward PE of 9. So we see that there could be significant re-rating, that they could be more profitable going forward. So based on the forward PEs, we would say that Wilson Bailey Homes would be the most expensive, and Murray and Roberts looks like they would be the cheapest based on the re-rating. When we put the PEG ratio, which is pretty much just using, so your forward PE is your price divided by your next year's EPS, and your PEG ratio is the current PE that you have divided by the growth. So that is the EPS growth rate. So there we see that Avenge looks the cheapest because it's got the lowest PEG ratio. Your EV/EBITDA method, again, shows that Murray and Roberts is the cheapest, and your price to book value shows that the low price to book value shows that Avenge is cheaper. So then we can go down and look at the companies, look at the ROEs, and if we go back, we can see we were looking at a company that's got a low PE, a high ROE, low risk, and high growth opportunity. So if we look at the ROEs of these four companies, we can see that Avenge's ROE is very low. So that could give us conflicting information about what the valuation on that company is. So whereas Murray and Roberts has got a decent ROE of 15%, it's not the highest, but it is quite substantial. So we must look at all these metrics together before we make up our minds about which companies we see on a relative basis are over or undervalued, because one metric might give us a negative signal, a wrong signal, which could impact on our decision as to whether a company is under or overvalued. That is all that we have for today.